Robert and Carol retire with the same $1 million, but one keeps cash while the other stays fully invested. Robert keeps a retirement cash buffer because he never wants to sell investments during a sudden market crash. Carol hates idle cash, so she keeps nearly every dollar invested and expects the market to reward her patience. At first, Carol's choice looks smarter because cash usually grows slower than a diversified investment portfolio. But retirement changes the equation because withdrawals can force you to sell assets at the worst possible moment. So we will give them identical spending, identical investments, and exactly the same 30-year retirement period. The only difference is Robert's cash reserve, which means every result comes from when they must sell investments. And the twist is that the strategy that wins during a crash can lose when the first years are unusually strong. Both retire at age 65 with exactly $1 million and need $50,000 from savings every single year. Robert holds $100,000 in cash and invests the remaining $900,000 in the same portfolio as Carol. Carol invests the full $1 million, leaving no separate cash reserve for her planned withdrawals. For this example, Robert's cash earns 2%, while invested money follows identical returns for both. Taxes, fees, inflation, pensions, and Social Security are excluded, so the cash decision stays isolated and clear. Now imagine retirement begins badly, with the market falling 20% during their first full year together. Carol must still fund her lifestyle, so she sells investments after the decline to produce the cash she needs. Robert uses his cash reserve instead, allowing his fallen investments to remain untouched during the downturn. After year one, Robert has about $772,000, while Carol finishes with roughly $750,000 remaining. The gap is already about $22,000, even though both started retirement with exactly the same wealth. Robert did not predict the market or avoid the decline. He simply avoided selling assets after prices had fallen. Carol owns the same investments, but her withdrawal permanently removes shares that could participate in recovery. Then year two gets worse, because the market drops another 10% before a meaningful recovery finally begins. Robert again draws from his cash, while Carol must sell another portion of an already damaged investment account. After year two, Robert has about $651,040, while Carol is left with roughly $625,000 remaining. The gap grows to about $26,040 before either investor has enjoyed a single strong recovery year. Now, the market rebounds, gaining 25% in year three and 15% during the following year. Both portfolios rise, but Robert owns more surviving invested assets because he sold less during the early decline. That difference matters because a recovery only compounds the shares you still own when prices begin moving higher. Carol participates in the rebound too, but the shares she sold for spending can never recover inside her account. By year five, Robert has about $860,323, while Carol holds approximately $820,031 in the account. The cash buffer advantage has expanded to about $40,291, even though the reserve itself earned less. This is the counterintuitive part. Lower return cash created value by preventing forced sales during bad markets. The cash did not beat stocks. It protected the stocks long enough for the remaining investments to recover later. After the first 5 years, assume both portfolios earn 6% annually while spending stays at $50,000. Robert's original cash reserve is now largely gone, so both retirees depend mainly on invested assets going forward. The early difference does not disappear, because every extra dollar Robert preserved can continue compounding for years. By year 10, Robert holds about $869,451, while Carol has approximately $815,532 still invested. Robert leads by about $53,919, even though both now face nearly the same market environment. Nothing magical happens after year 10. The early sequence simply keeps influencing every later portfolio balance. By year 20, Robert has about $898,014, while Carol is down to roughly $801,454 in her account. The gap is about $96,560, driven mainly by avoiding forced sales during those first 2 bad years. By year 30, Robert finishes with about $949,167, while Carol ends with roughly $776,243 remaining. Robert finishes approximately $172,925 ahead, despite starting with less money exposed to the market. That seems to prove a cash buffer always wins. But stopping the experiment here would create the wrong conclusion. Cash has an opportunity cost, and that cost becomes visible when retirement begins with strong market returns instead. So rewind the same retirees to day one and change only the order of returns during their first 5 retirement years. This time, the market rises 20% first, then 10, 8, 7, and 6% in the next 4 years. Robert still keeps the same $100,000 cash reserve, earning 2%, while Carol remains fully invested. Now Carol benefits because more of her money participates immediately in the strong opening years of market growth. After year 1, Robert has about $1,132,000, while Carol finishes near $1,150,000 in total wealth. Carol is ahead by about $18,000 because Robert's cash reserve missed part of the early market gain. After year 2, Robert has about $1,191,040, while Carol reaches approximately $1,215,000 total. The gap grows to about $23,960 without Carol making any smarter investment or spending decision. Her only advantage is that more capital was invested when the market happened to deliver positive returns early. Robert's reserve still provides safety, but in this sequence, he pays for protection that he never actually needs. By year 5, Robert holds about $1,299,031, while Carol has roughly $1,328,587 in her portfolio. Carol leads by about $29,556, and the cash buffer now looks like expensive unused insurance. If both earn 6% afterward, Carol's early advantage gets decades of additional time to compound further. By year 10, Robert has about $1,456,542, while Carol holds approximately $1,496,095 in total. The gap is roughly $39,553 in Carol's favor because strong early returns rewarded full investment. By year 20, Robert holds about $1,949,405, while Carol has approximately $2,020,238 in total. Carol's lead grows to about $70,833 even though neither strategy changes after the opening years. By year 30, Robert ends near $2,832,047, while Carol finishes with roughly $2,958,899 in total. Carol leads by about $126,852 because the cash reserve reduced exposure during strong early markets. So which character was right, Robert protecting against a crash, or Carol maximizing every dollar of market exposure? The answer depends on sequence risk because retirees cannot know whether strong or weak returns will arrive first. Workers can often wait through a crash without selling, but retirees may need portfolio money every single month. That turns liquidity into something more valuable than its interest rate because it can control when assets are sold. Vanguard describes cash as funding for near-term expenses so long-term investments can stay focused on growth goals. Vanguard also notes retirees may hold up to 12 months of expenses or more depending on their circumstances. Schwab suggests a year of expenses in cash plus several years in high-quality short-term investments for retirees. Those are planning frameworks, not proof that every retiree should keep exactly 2 years sitting in a bank account. Too little liquidity can force sales during a crash, while too much cash can quietly sacrifice decades of growth. That means the correct question is not whether cash is good or stocks are better for long-term wealth creation. The real question is how much short-term stability you need before the opportunity cost becomes unnecessarily large. Robert's 2-year buffer worked brilliantly in our bad opening sequence because the reserve absorbed both withdrawals. Carol's fully invested strategy won the strong opening sequence because every available dollar participated in growth. Neither result required stock picking, market timing, or a prediction about what the market would do next year. The difference came from matching money needed soon with liquidity and money needed later with long-term investments. A retiree with large Social Security or pension income may need much less portfolio cash for basic monthly expenses. Someone relying almost entirely on investments may value a larger reserve because withdrawals cannot simply be skipped. Spending flexibility matters too, because reducing withdrawals during a crash can accomplish part of what cash does. Fidelity specifically highlights flexible spending and cash flow sources as tools for reducing sequence of return risk. So, a cash buffer is not a return strategy. It is a risk management tool with a measurable opportunity cost attached. If the market crashes early, that cost can look tiny compared with the damage caused by repeatedly selling at losses. If markets surge early, the reserve can become a drag, while the fully invested retiree compounds a larger asset base. The hidden money equation is not cash versus stocks, it is forced selling risk versus the cost of unused liquidity. Robert paid for control over when he sold investments, while Carol accepted more sequence risk for higher exposure. The better choice depends on which risk would hurt your retirement more, not which strategy wins every spreadsheet. So would you rather keep 2 years of spending ready or trust the market when your next withdrawal comes due?